Welcome to a moment in stock market history where the unexpected becomes reality. A few seconds ago, the financial world held its breath in expectation. Just when you thought the market had dealt us all its cards, the game turned abruptly. Elon Musk, the mysterious founder of Tesla, just revealed something shocking to Wall Street. Tesla tweeted that, quotation this morning, in order to achieve a stock split, end quote, Tesla will put the authorization of extra shares to a vote among shareholders at this year's annual meeting. In an additional filing with the SEC, this morning, Tesla clarified the same points. Although the document mentions a dividend, it is still a stock. Dividend, this isn't Tesla establishing a quarterly cash dividend on the stock. Rather, it's the exact same split structure that Tesla previously employed. This morning, CNBC's Phil Bo tweeted that Deutsche Bank increased their Q1 earnings expectations. Phil claims that Deutsche Bank stated that they are increasing their forecast. Because although I haven't seen any publications on this beyond this quarter, we continue to be impressed by Tesla's operational execution in the face of industry supply chain challenges and by its pricing power, which could allow it to more than offset the sharp pressure on raw materials. In today's special episode, we'll delve deeper into this groundbreaking announcement, which is very similar to the conclusions that we have heard other analysts reach. How will Elon Musk's most recent action affect investors, the market, and the prospects for electric vehicles? What does it imply for Tesla's stock? Come along with us as we solve the mystery, Powerhouse analyze the ramifications, and investigate the unexplored areas of Tesla's market journey. We can help you with everything from the small print to the big picture. This isn't just another market update. This is Tesla Insights, where finance and the future collide. Stay tuned as we prepare to go on an exciting journey through the world of stocks, strategy, and Elon Musk's genius. Welcome to an exciting edition of Tesla Insights, which you will definitely enjoy. Furthermore, join our channel now that the holiday season is well underway. Let's talk about a special subject that needs our consideration: possible third stock split for Tesla. We haven't talked about this topic on this channel before, but it seems appropriate to do so, now that Tesla appears to be about to make another significant breakthrough. It's important to comprehend both the advantages and disadvantages of a stock. Tesla's results from its last two stock splits paint an interesting picture, but keep in mind that historical performance does not predict future outcomes. Tesla's shares increased by 81 in August 2012 between the announcement and the split, then fell by 14 the next month. Nevertheless, the stock recovered spectacularly, rising by roughly 6 months after the initial 5-for-1 split, which essentially quadrupled the number of shares while lowering the price by a fifth. Tesla announced its second split in August 2022, this time a 3-for-1, with the goal of increasing stock ownership accessibility for investors and employees. Prior to this separation following the news, Tesla's shares surged over 46 to nearly $13,115 per share, a significant increase from over $2,000 before the first split in 2020. However, following the split, the company saw a 15% decline due to recent occurrences. Elon Musk, the CEO of Tesla, started talking about the company's acquisition of Twitter and the subsequent sale of Tesla stock, which marked a significant turning point in the company's history. This period also coincides with the observation that Tesla has seen impressive gains after its previous two splits. Due to different market dynamics, as we move toward 2024, the first split performed better than the second. Market rumors indicate that there may be 6 to 7 rate cuts, which could result in a situation similar to 2020, even though interest rates aren't at zero, but rather are declining. Market lubricity rate cuts are a tactic used by central banks, such as the U.S. Federal Reserve, to boost economic activity by lowering interest rates, which makes borrowing more affordable for both consumers and businesses. In companies, this results in higher investment and consumption, which can support economic growth. The projected course for 2024, similar to the global economic climate of 2020, central banks throughout the world slashed interest rates to almost zero levels in response to the COVID-19 pandemic. These cuts were part of a larger strategy to maintain market liquidity and promote investment and spending during a time of unpredictability. However, it is not anticipated that interest rates will fall to the historically low levels seen in 2020 and 2024. The anticipated sequence of rate cuts points to a change in monetary policy that is more accommodating. This change is thought to be a reaction to a number of economic factors and indications. When borrowing becomes more affordable, market liquidity typically increases due to lower interest rates. When money is flowing through the economy, companies are more willing to invest in expansion prospects, and consumers may increase their spending on goods and services, which can result in a more lively and dynamic market. After a time of controlling inflation or the economy recovering, the anticipated rate cuts in 2024 may indicate a change in economic objectives. While the goal of central banks may be to boost growth, the balancing act makes sure that these cuts don't overstimulate the economy and put investors at risk of inflation. Lower rates can make equities more appealing than bonds, increasing the stock market. The anticipation of rate cuts frequently delivers a bullish outlook. Cheaper borrowing costs also benefit investment companies, possibly enhancing their stock prices and financial performance. This is in sharp contrast to the circumstances in 2020. The approaching year suggests a more accommodating Federal Reserve, which might foster a positive market environment, particularly for interest rate-sensitive equities like Tesla, and even influence small and mid-cap stocks. The market liquidity was continually being drained. In the past, when Tesla's shares were trading between $150 and $200, the talk of a stock split seemed implausible. However, with the stock potentially reaching new heights in 2024, the conversation has gained legitimacy. Projections for 2012-2024 range from a bullish scenario of $600 per share to a bearish estimate of roughly $350. According to a recent article from 247 Wall Street dated November 4th, there is a chance that Tesla will split again if shares surpass $400 in 2024. The main reasons for this are to make the stock more accessible, particularly for people who can't buy fractional shares through certain brokers like Vanguard stock splits, and to make stock-based compensation for employees simpler. Although stock splits don't necessarily increase a company's value, they have historically attracted increased investor interest and retail inflows, posing challenges for short sellers. Additionally, another stock split might position Tesla as a potential component of the Dow Jones Industrial Average, a index that currently lacks an automaker since General Motors' removal in 2009. It's interesting to note that past stock splits have served as catalysts, significantly increasing Tesla's market attention. For example, in August 2020, Tesla shares jumped 80 when between the announcement and the split's execution. Due to its popularity and profitability, Tesla is a desirable candidate for the Dow. However, because the Dow is price-weighted, the price of Tesla's stock will have a big impact on whether or not it is included in the index. As of late 2023, only one Dow component is trading for more than $1,500 per share, indicating that Tesla would prefer to trade between $100 and $1,200 per share rather than at higher prices above $1,400. A likelihood of Tesla splitting its third stock is increasing, especially if its stock price rises above $400 or even $300 per share. This action could have a big impact on the Dow Jones Industrial Average and prevent Tesla's performance from having an outsized impact on the index at $1,400 per share. Given the company's trajectory, a realistic target for Tesla's market value by 2024 would be $1.25 trillion. Despite dealing with historically high interest rates and inflationary pressures, Tesla has continued to deliver strong performance, even though the cuts did not reach the extreme lows of the pandemic era. This change could result in increased market liquidity, which would stimulate economic growth and positively impact investor sentiment. Now, let's consider a few questions. What impact would these projected rate cuts have on your investing tactics? Do you believe that this is the beginning of a more robust economic recovery? How might Tesla, a major player in the stock market, navigate and profit from this shifting financial environment? Please share your opinions and join the conversation. If you found this information insightful, don't forget to hit the like button. Additionally, for additional updates and analysis on the changing dynamics of the market, subscribe to Tesla Insight. We appreciate you viewing, and we hope to see you in our upcoming videos.